Hi guys, this lesson we are going to talk about how volatility affects option premiums. Volatility is how much the stock price fluctuates. There are two types of volatility, historical and implied volatility. Historical measures the past fluctuation of stock price. This is a chart of two stocks' performance over the same time period. Red stock has higher historical volatility than green stock because it swings up and down more than green stock does. We can use historical volatility to determine which stock can have potential to give you higher returns depending on your trading style. Next up, we have implied volatility. It is what the market believes what the volatility of the stock will be in the future. It is a big part of option Greeks, Vega. Let's say we have a stock trading at $100 with implied volatility of 30%. If you know a little about statistics, you've heard of one standard deviation, two standard deviation. The IV follows normal distribution. So since 30% of $100 is $30, 30% IV here is telling us that there is a 68% chance of it being between $70 and $130, which is plus or minus one standard deviation, and there's a 32% chance of it being outside of this range, 16% chance of it being above $130, and 16% chance of it being below $70. Be sure to keep in mind that this normal distribution is non-directional. It's not telling you that it will go above $130 or below $70. You want to use it to determine whether a contract's premium is cheap or expensive. Low IV means that your 68% area under the curve has a really low plus or minus, which could mean your contract can increase in premium or has a higher chance of increasing in premium. Implied volatility also has an impact on your premium's extrinsic value. Remember from our lesson before, every 1% change in IV, it changes the premium depending on your option's vega. Remember from earlier, low IV means you have potential to increase your premium. Same way if you have high IV, it is potential for you to lose premium if your IV decreases. So be sure to look out for that when you are choosing your options. There are some possible reasons that can change the IV. It could be government policies, regulations affecting that company. If that company gets upgraded or downgraded by an institution like Morgan Stanley or Goldman Sachs. It could also be new product releases like NVIDIA's new graphic cards. And rumors like PayPal buying Pinterest last year that didn't end up happening. But I could say earnings have biggest impact on the IV because of the uncertainty by the traders. No one is sure about the performance of the quarter or the guidance the company is going to provide for next quarter. The IV is usually the highest around companies' earnings. Now that we know historical and implied volatility, how can we apply them together? You can find your historical volatility this way on Thinkorswim. Basically, if a stock has IV of 20% and HV of 10%, that means the stock is expected to be more volatile in the future. And higher IV in the future means higher premium. Vice versa, if the stock has HV of 20% and IV of 10%, that means the stock is expected to be less volatile and expect to lose premium in the future.